7.5 million Americans were enrolled in the most affordable federal student loan repayment plan in history. That plan ended last week. The SAVE plan, Saving on a Valuable Education, was vacated by a federal court on March 10, 2026, after years of legal challenges. Starting July 1, loan servicers began sending every SAVE borrower a notice. The clock starts the moment that notice arrives. They have 90 days to pick a replacement. Those who don't choose get automatically placed into a standard repayment plan, fixed monthly payments, no income adjustment, which financial aid experts at NPR have confirmed will cost more than SAVE did. This is not a story about whether you borrowed too much or should have paid it off faster. The rules changed underneath you. The only question that matters right now is whether you act before your 90-day window closes or let the default happen. This video is about one thing: the move to make before September, what ended and what replaced it. Before July 1, federal student loan borrowers had 7 repayment plan options. The U.S. Department of Education noted that 70% of borrowers reported feeling overwhelmed trying to navigate them. Effective July 1, the Working Families Tax Cuts Act collapsed repayment into 2 options for new borrowers going forward. RAP, the Repayment Assistance Plan. This is the new income-driven option. Monthly payments range from a minimum of $10 to a maximum of 10% of your adjusted gross income, your total income before certain deductions. The government waives any interest that exceeds your monthly payment, so your balance cannot grow if you pay on time. And if your payment doesn't reduce your principal by at least $50, the government chips in the difference. For a borrower earning $45,000 with $35,000 in debt, RAP calculates a payment of approximately $150 per month, lower than the $176 they would have paid under the older IBR formula, and with a guaranteed balance reduction each month. The tiered standard plan, fixed monthly payments. Term depends on loan balance, 10, 15, 20, or 25 years. Minimum payment of $50. This is where borrowers land if they don't choose. It is not income adjusted. If your income drops, your payment doesn't. Who is affected, and what to do? Your situation depends on which plan you're currently on. If you're on SAVE, your loans have been in forbearance since 2024 while the legal challenge played out. Starting July 1, your servicer is sending you a notice that starts a 90-day clock. That deadline falls around the end of September or early October 2026 for most borrowers. After that window, the department places you in a standard plan. Action: log into studentaid.gov. Open the loan simulator. Run your numbers under IBR and under RAP side by side. More on which one to choose in a moment. If you're on PAYM or ICR, both plans are being phased out on July 1st, 2028. You have 2 years, but the decision clock is running. Do not wait until 2028 to compare your options. If you're on IBR, you can stay on IBR or switch to RAP. IBR is not being eliminated. But be careful. If you take out any new federal loan after July 1st, 2026, you lose access to IBR on your existing loans and move to RAP or tiered standard for everything. Before we go further, drop your current repayment plan in the comments. SAVE, IBR, Pay, Standard, or Not Sure. I want to see the breakdown of what people are actually on right now. There is a cost hiding inside the forgiveness promise on every income-driven repayment plan that your servicer will not mention in the 90-day notice. It could mean a tax bill in the year your loans are finally cleared. I will give you the exact number in about 3 minutes. Here is the thing I want to say before we go further, because most coverage on this topic frames RAP as the obvious choice for SAVE borrowers. It is not. Most borrowers will be better off in IBR than in RAP. That is not my opinion. That is a direct quote from Mark Kantrowitz, a widely cited higher education expert who spoke to CNBC. Forgiveness under IBR comes in 20 or 25 years. Forgiveness under RAP comes in 30 years. That is 5 to 10 additional years of payments. 30 years. Most IDR borrowers are already a decade or more into repayment. Switching to RAP resets that clock and adds years at the end. And here is the piece that matters most. RAP is a one-way door. Once you enroll, you cannot switch back to IBR or any other income-driven plan. The Department of Education has confirmed this. If you move into RAP and later realize IBR would have been better for your income and debt level, you cannot undo it. RAP does have real advantages for a specific group. Borrowers who were trapped in negative amortization, meaning their payments were smaller than the monthly interest accruing, so their balance kept growing even while they paid. RAP eliminates that problem with its interest waiver. For that borrower, RAP is genuinely the better outcome. For everyone else, especially borrowers already close to forgiveness under an existing plan, the default advice of just enroll in RAP deserves real scrutiny before you sign. The comparison that determines your choice. And then the cost I mentioned, the one hiding inside the forgiveness promise. RAP versus IBR. The comparison that determines your answer. Here is the comparison, line by line. Payment calculation. RAP uses your full adjusted gross income. IBR uses your discretionary income, the income above 150% of the poverty line for your family size. For a single borrower earning $60,000, IBR's discretionary income calculation produces a lower payment than RAP's full AGI formula. Interest treatment. RAP waives unpaid interest monthly. IBR does not offer that protection. If your IBR payment is below the monthly interest, your balance can grow. This is the strongest argument for RAP. If your payment is less than your monthly interest, IBR lets your balance climb. Forgiveness timeline. RAP forgives after 30 years. IBR forgives after 20 years. Loans after July 1, 2014. Or 25 years. Older loans. That 5 to 10-year difference in total repayment is significant on a middle-class income. One-way door. RAP locks you in. IBR allows you to switch to other eligible plans if your situation changes. PSLF eligibility. Both RAP and IBR qualify for public service loan forgiveness, 10-year forgiveness for borrowers in qualifying government or nonprofit roles. The decision rule. If your payment under IBR is less than the monthly interest accruing on your balance, meaning your balance is growing even while you pay, RAP's interest waiver makes it the better option. If your IBR payment covers your interest, IBR's shorter forgiveness timeline and flexibility make it the stronger choice. The loan simulator at studentaid.gov runs both calculations with your actual numbers. That output, not this video, not your servicer's recommendation, is the right basis for this decision. Here is what nobody can tell you right now, including me. The 90-day transition window for 7.5 million SAVE borrowers started July 1. The servicer notices are going out this week. Nobody knows yet how many borrowers will successfully switch to a plan of their own choosing before the deadline, versus how many will be auto-enrolled in the standard plan because the notice got lost in their spam folder, because the studentaid.gov portal was slow, or because the information in the notice was too confusing to act on. What happened during the 2022-2023 payment restart after the pandemic pause is the most relevant precedent. Millions of borrowers were placed in wrong plans, received inaccurate information from loan servicers, or missed deadlines through no fault of their own. The CFPB received tens of thousands of complaints about servicer errors in that period. Act early, not at the deadline. The closer you get to October, the higher the probability that capacity issues at servicers or technical problems at studentaid.gov work against you. Here is the cost hiding inside the forgiveness promise. Under the American Rescue Act of 2021, student loan forgiveness received through income-driven repayment plans was exempt from federal income tax through the end of 2025. That exemption ended. It has not been extended. For any borrower who receives income-driven repayment forgiveness in 2026 or later, the forgiven amount is taxable as ordinary federal income. On a $40,000 forgiven balance, at a 22% federal marginal rate, that is an $8,800 federal tax bill due in the year forgiveness occurs. On a $60,000 balance, $13,200, $8,800. For a borrower who qualified for forgiveness precisely because their income was limited, public service loan forgiveness is still exempt from federal tax. Income-driven plan forgiveness is not. If you are building toward IDR forgiveness, under IBR, RAP, or any other plan, the forgiveness year needs to appear in your tax planning long before it arrives. You did not create the SAVE plan. You did not create the lawsuits that ended it. You were managing your loans under the rules that existed, and a federal court changed those rules in March 2026. Nobody owes you an apology for the timing, but the 90-day window is yours to use. The comparison takes 10 minutes on the loan simulator. The enrollment takes another 10 minutes. Your one move before this week ends. Log into studentaid.gov, find your current plan, open the loan simulator, and run IBR against RAP with your actual numbers. That output tells you which door to walk through. Are you on Save, IBR, Pay, or something else? And do you know when your 90-day window closes? Drop both in the comments. I want to see how many people are in the window right now. If this is your kind of channel, subscribe. See you in the next video.